Have you ever just stared at a trading chart, kind of feeling like you're just guessing which way the market's going to go next? Yeah, it's a super common frustration. But what if I told you there's a secret language hidden in plain sight on that very chart? Because today, we're going to decode one of the most powerful clues there is, a clue that tells the real story of every single market battle.
Seriously, what if every single one of those candles could actually tell you a story? A story about the tug-of-war between buyers and sellers. That's the whole idea we're diving into. So let's forget about all the complex indicators for a minute. We're going to focus on the raw story of price told by one of the most overlooked parts of a candlestick.
And we're talking about the wick. It might just look like a little line sticking out from the candle's body, but trust me, it is the key to understanding the market's immediate intention. It shows us its sentiment and, most importantly, where it's rejecting price.
So what exactly is a wick? Well, think of it like a footprint. It shows you precisely where the price tried to go, but failed. It's the visual evidence of a battle. A long wick means one side put up a serious fight and won, pushing the price all the way back. It's this powerful story of rejection, and, it's often a clue about who is really in control of the market.
And interpreting them is incredibly simple. Look at the left. A long upper wick means sellers just screamed, "Not so fast," and slammed the door on higher prices. And on the right, a long lower wick means buyers stepped in and said, "Nope, not down here," rejecting lower prices and defending their ground. Each wick is a super clear signal of who won that fight at that specific price level.
Okay, so understanding the clue is one thing, but how do we turn it into a repeatable, actionable trading plan? That's what we're doing next. We're going from the why to the how with a simple 5-step blueprint.
So here's our whole roadmap. First, we find our battlegrounds on the higher timeframes. Second, we patiently wait for that key rejection signal, the wick. Third, and this is so important, we use the next candle to trigger our entry for confirmation. Fourth, we define our risk with a clear stop loss and target. And finally, for that extra bit of confidence, we can confirm with volume. So let's break down how this all builds, step by step.
All right, let's get into the nitty-gritty of this strategy. We're going to walk through exactly how to put this plan into action, from the initial setup all the way to execution. First things first, context is everything. You don't trade these wicks just anywhere. You start on a higher time frame, maybe a 15-minute or 1-hour chart, and you mark out the major support and resistance levels. Think of these as price ceilings and floors. These are the historical battlegrounds where big moves happen, and where a long wick signal becomes incredibly powerful. So, once the price gets close to one of your key zones, you zoom in to the 5-minute chart. Now, you're a sniper. You're waiting for a very specific signal. A candle with a long wick pushing against your level and a small body. This is the visual confirmation you're looking for, that a real struggle is happening right where you expected it to.
Now, this next part is absolutely crucial. You do not enter on the wick candle itself. Patience is your biggest edge here. You wait for the next candle. So for a bearish setup, you'd only enter a short position when that next candle breaks below the low of the wick candle. That's what confirms the sellers are following through. And obviously, the exact opposite is true for a long trade. This step keeps you from jumping the gun on a false signal.
And of course, no trade is complete without managing your risk. And this setup makes it beautifully simple. Your stop loss goes just on the other side of the wick that signaled your entry. It's your emergency exit if you're wrong. For your target, you can aim for a solid 1-to-2 risk-to-reward ratio, or you can target the next major support or resistance zone.
Now, those first 4 steps give you a complete, tradable strategy. But if you want to really increase your confidence in a trade and maybe boost its probability, there's one more layer we can add. Let's talk about the power of volume.
The logic here is so powerful. If you see that long wick form on a huge spike in volume, it means a massive number of orders just flooded the market to cause that rejection. That is a very, very strong signal. But what if the same wick forms on low volume? You got to be careful. It could just be market noise, a potential fake out. High volume shows real conviction.
Okay, before we wrap this up, I want to leave you with a few pro tips. These are the little adjustments that can really separate consistent traders from beginners and will help you truly master this technique. These tips are so critical. First, only take these trades at the extremes, at your key support and resistance levels, not in that messy, choppy mess in the middle of a range. Second, and I know I've said this a few times, but it's that important, always wait for that confirmation candle. Impatience is an expensive habit in trading. And third, start learning about liquidity zones. Those areas where big pools of orders are just sitting. Because understanding those, well, that's where the real magic happens.
Here's why that last tip is so important. A lot of times, these long wicks are not random. They are calculated moves by institutional players to hunt the stop-loss orders of retail traders, which creates liquidity for their own huge positions. When you see a wick, you're often seeing the footprint of a big player trapping everyone else. By trading with the wick, you're trading with them, not against them.
So I'll leave you with this question to think about. When you start to apply this strategy, you're really shifting your whole perspective. You're no longer just trading lines and patterns on a screen. You're trading the raw, real-time story of rejection and control in the market. And let me tell you, that is a much more powerful way to read a chart.